Hello and welcome to Market Domination. I'm Jared Blikre in for Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell and stocks are edging higher. And that's after 2 weeks of downdrafts. So let's check out the Dow here, which is up about 320 points or 0.2%. And I'll show you the intraday price action. We are pretty close to the highs of the day, notched about an hour or two ago. NASDAQ Composite been kind of treading water over the last few hours, but still looking at gains just over 0.5%. And the S&P 500, very similar return here at this level for most of the day. But we got to check out the small caps. We're going to have a conversation about that later. The Russell 2000 was outperforming the S&P 500 for a record 14 days as of Friday. That streak is broken right now. Well, assuming that the Russell 2000 doesn't pull out a miracle into the close, it is down about 0.3%. S&P 600, meanwhile, is just barely positive. That's another small cap gauge. And the S&P 400, the mid caps, that's just barely underwater. But let's check out what's going on in the bond market. We see yields broadly down, 4.21% for the 10-year T-note yield, and that is down 3 basis points. 30-year also down 3 basis points to 4.80%. And the U.S. dollar index, that is down 0.5%. We've seen the Bank of Japan and some possible currency intervention headlines around since Friday, so we'll dig into that a little bit as well over the show. But I do want to get to some of our heat maps here. We will start with the large cap sectors, and leading is tech. This hasn't happened a lot lately. We've seen a lot of other sectors kind of jockey for position, but tech is back on top. AI trade maybe front and center. So is utilities. Utilities bouncing back from a red day on Friday as they were underwater. Then we got communication services and financials. All four of those sectors outperforming the S&P 500. To the downside, we've got consumer discretionary, consumer staples, and energy just barely in the red. But it's been the consumer stocks that are getting hit the most today, at least in large cap land. So let's take a look at the NASDAQ 100, where we have a lot of our tech stocks. NVIDIA in the upper left, that's down 0.7%. We're going to be talking about a new chip from Microsoft going into data centers in just a minute here. Apple up 3%, Broadcom up 2%, Meta just there with it. And if we check out the semiconductors, aside from some of the big ones, we see a lot of green here. AMD down 3% as well, though. But software, which has been the laggard this year in tech, it is looking very green today. Oracle, Cisco, SAP, all three of those, plus CrowdStrike up 3%. Datadog and Atlassian up over 4%. And I got to get into some of the weather trade here because no lie, I'm wearing winter pants and boots here. But check out natural gas for February delivery. That is up 25% today alone. Let's just get the price on that because it was $3 last week. It is now $6.50. So huge spike up there in natural gas as heating demands and heating costs are rising. Then we got silver. I got to show you the price on this too because we hit $111, $112 at the highs today, but we have been seeing triple digits silver since Friday. And one more I got to show you the price on. That would be gold futures. You can see we're off the high here, but we are well above $5,000 an ounce. Goldman Sachs raising their price target on gold into the end of the year. And I want to show you some more weather trades here. And I will start off with the airlines. There we go. You can see broad-based weakness, although we do have a few standouts. Viking Airlines, that's up 2%. Southwest just barely positive, but JetBlue kind of a sore spot there. That is down 3% as we look at a lot of cancellations over the weekend. And we got to check out the retail sector as well. Some of the bigger ones doing all right, as you might expect. Amazon still holding water there. That is up 0.2%. Walmart just in the green there. Home Depot and Lowe's, the home improvement trade doing well. But if I sort by performance, you're going to see a lot of the specialty retailers, including some of the big ones, even Target down 3%, but Ulta Beauty down 3.5%. This is a continuation of the trend we saw from Friday, and we're going to be talking about consumer discretionary stocks well into the next hour. Also want to show you utilities. These are bouncing back from that loss I told you about Friday, and then insurance stocks. Those were red on Friday, but they're looking green today. So markets starting a busy week with gains, and we're looking at another positive month for the S&P 500 with just a few days to go. And my next guest says we could see a shift in the market this week. Joining me now is Mike Mussio, FBB Capital Partners President. Mike, thanks for joining us here today. Let's start with the weather and talk about earnings since we got both of those going on here. I was just reading a B of A report. They expect U.S. GDP in the first quarter to take a hit of about 0.5 percentage point to 1.5 percentage points. How is that going to show up in stocks?
Yeah, well, stocks follow earnings, earnings follow growth. So, a hit in growth this quarter versus last quarter could definitely impair earnings a bit. But I would say the rate of growth is still above quarter to quarter of where expectations were certainly a couple years ago. And I think that stocks are looking through that. Certainly, companies are looking through that. If you look at expectations for capital expenditures this year, they don't really show signs of slowing down. The growth rate may be slowing a bit, but the actual absolute dollars for expenditures there are expected to continue to be high. So it's good that we have a positive bounce here after a pretty weak early part of last week. And as you said, Jared, finishing or looking to finish January in the positive. So we're fully invested. I think our conversations with clients have been, we want to be fully invested, but we don't want to be fully invested in one thing right now. And we expect U.S. Large cap stocks to do well, but there are a lot of other things doing well right now as well.
Well, let's talk about those. So I'd be interested in what else besides U.S. large cap stocks and any industries, any sectors in particular in the large cap space that you like.
Yeah, so beyond large cap, pretty much broad-based other asset classes are doing well. Small cap stocks, which you mentioned at the top, have outperformed year to date pretty handily. A little bit weaker today, but it's had a heck of a run over the last couple of weeks.
Yes.
Precious metals, which you also mentioned, continue to do well as dollar continues to be questionable to weaker. And international companies, partially because of that dollar trade, have started the year off pretty strong also. So in terms of like the risk asset kind of profile, or even within some of the precious metals, a safe haven profile, those investments have started the year strong. Within large cap, sectors beyond technology, there has been a broadening out. So if you just look at large cap, S&P 500, for example, another sub kind of different way to slice and dice that versus market cap weighted S&P, the equal weight index has done a few turns better than the broader base, market cap weighted S&P. And so if you broaden that out, that means, again, some of those companies that are a little bit closer to mid cap, but other sectors, equally weighting those companies and getting a little bit more exposure to some of those sectors. Energy has done well, as you mentioned. Utilities have had a pretty decent start overall. So broad diversification. This doesn't mean the tech trade is over, but it does, we think, mean overall means a more solid and stable kind of jumping off point for the market in 26 if we have broader based participation across these other sectors.
Yes, and rotation is the lifeblood of a bull market, and we've finally seen some of that here. But within tech, software has really flagged this year. I'm just wondering, and a lot of that has to do with the AI trade, the thinking perhaps being that software is not going to be as valuable as it used to be. So what do you say to the investors who are in tech? Should they be focusing more on the chip space or something else?
Yeah, so for us, chips, hyperscalers, the value chain for us of AI is everything from a couple companies. Again, you mentioned at the top, you showed ASML, Taiwan Semi in terms of production. You've got the designers and the actual chip companies. Software has definitively lagged, the exception kind of being, over the last year and a half, being Microsoft because of its classification as an actual software, but also a hyperscaler. So there are opportunities there, but it has been a tough place. Even the things that had outperformed in software in 23, early 24, a lot of those companies had a really tough 25 comparatively. So there's some really good companies there. They look cheaper than they were a couple years ago, but we'd be fairly selective.
All right. I want to ask you about the Fed here. There's a lot of talk about Fed independence. We're actually going to be speaking with former Atlanta Fed President Dennis Lockhart later in the show about independence. But I want to ask you about rate cuts here. Do we need them this year, or can the market do without them? How many do you think are priced in? Just lay the land out for us on the interest rate cuts.
Yeah, we always take the position, that people say, like, don't, the mantra is don't fight the Fed. Sure. And we agree with that. But at the same time, we always kind of caution people, like, be aware, be aware of what it is you're asking for. If the Fed lowers rate, particularly significantly, which some seem to be calling for, when they do that historically, those are pretty scary times as an investor or just somebody working in the overall economy. So the measured approach, while they were certainly late to the game in terms of tamping down inflation in 22 and early 23, probably waited too long. A more measured approach, again, just like it is with stocks and earnings, Jared, right? Like if we let earnings of stocks kind of have a steady, a session or a couple quarters, and earnings are able to catch up with prices, and then we kind of create a new base and go on from there. That's a healthy market. So if the Fed is seeing employment figures that they feel comfortable with, inflation still not where we know that they want it long term, but it's directionally okay to stable, and they feel like they can wait to add more easing, then that's probably healthy for the overall market. In terms of what the market participants are pricing in, it should be, to me, no surprise to anyone that they're expecting pretty much zero cuts until June, which is when the next Fed chairperson will be in place, and then they're expecting a cut. And so if you look at what the market's pricing in, I think it's cut in June and maybe two more in the back half of the year. We would take, probably the under there, assuming nothing major happens with the market and the economy. And again, if it does and they're cutting, then that's not necessarily, the best case scenario for the economy or for markets.
No, if they have to catch down, that's not the greatest situation, but certainly not looking that way just yet. Mike, really appreciate your insights here. So thank you so much.
Thanks, Jared. Have a great one.
You too. Coming up, we look at how CEOs of Minneapolis-based companies are reacting to the unrest in the city. Stay tuned. Microsoft is taking aim at Google, Amazon, and NVIDIA with a new AI chip. Yahoo Finance's Dan Howley joins us with all the details. Please.
Hey there, Jared. That's right. Microsoft announced its Maya 200 chip. It's basically built specifically for AI, and Microsoft says that it'll be running in its data center with its super intelligent business, basically to run its own and open AI models. And so it's just kind of getting started using the chip, and then eventually it'll open it up to third-party customers to be able to use from Microsoft's data center. So it's not exactly selling these chips at all, but if people want to be able to run some apps using it, they will be able to when they sign up for Azure and such. This is down the line again. And it really is basically a response to two things. One is Google and Amazon and their own chips. We've seen Google, they're on their 7th generation custom AI chip. Amazon has their 3rd generation chip as well. And then to kind of reduce their reliance on NVIDIA's chips. So it's kind of a threat to NVIDIA, as we've seen from the headlines where Google announces a new chip, Amazon announces a new chip. This idea of Microsoft and Google and Amazon being threats to NVIDIA is real in the sense that it takes away business from NVIDIA that these companies would ordinarily be. But I don't see this as being something along the lines of an existential threat to NVIDIA. None of these chips are going to be kind of as powerful or as general purpose as NVIDIA's own chips. But it is still something that's worth keeping an eye on, because NVIDIA does get a lot of its revenue from these hyperscalers, somewhere a little bit along the lines of around 50%, I believe, a little more, a little less, but it's in that ballpark. And so, if at some point these companies decide to just go all in on their own chips, then that would be a blow to NVIDIA. However, their customers of these big cloud companies are going to want them to continue to offer NVIDIA chips as well as AMD chips. And so I don't foresee that happening. I don't think anybody really sees NVIDIA being replaced by these. But it is still another interesting evolution in this kind of AI build out that we're seeing.
Yeah, Dan, and just looking at the Wi-Fi Interactive, I was showing the semiconductor heat map in the open here. NVIDIA down less than 1%, Intel down 6% after a real hit last week after earnings, AMD down 3%. But just talk to us about the broader trend of a lot of these companies making their own chips, and what does that do for the importance of having fabricators. So not everybody makes their own chips. NVIDIA doesn't actually fabricate their own chips. Taiwan Semi does. So we know Taiwan Semi is an important player there. Intel is trying to compete against them, and they're getting a lot of federal backing, a lot of federal funds to build out chip fabrication plants in the US. So maybe talk to us about that longer term trend.
Yeah, I mean, TSMC is basically the manufacturer for, AMD, Apple, NVIDIA. I mean, you name it, they're building chips for them. The one that does its own, soup to nuts kind of design and manufacturing is Intel. Both companies are getting money or at least some kind of funding or some kind of tax breaks from the federal government to kind of boost the production of chip manufacturing here in the US. Most of it is in Taiwan or other countries, with the exception of Intel. But Intel also has global factories as well. And I think one of the big things to point out when it comes to the kind of chip building ecosystem is that just because you construct a chip here or you manufacture a chip here doesn't mean that the entire ecosystem is here, right? Silicon wafers can come from somewhere in Germany. They will have different lines of production in different countries.
Yep, thank you for that report, Dan. And we are tracking the latest developments coming out of Minnesota. CEOs from major companies, including Target, United Health, 3M, and more than 60 others, are calling for an immediate de-escalation. That's a quote, after deadly confrontation involving federal law enforcement. It's a rare moment of public intervention from corporate leaders, even as political decisions increasingly spill into business decisions. Helping us think through this moment, we are bringing in Gautam Mukunda. He is a Yale School of Management Executive Fellow and author of Picking Presidents. Thank you for joining us here today. Let's talk about the CEO letter. Alex Preddy's name was not mentioned. President Trump was not mentioned, nor was ICE or immigration. What are you reading in this?
So I think that the level of chaos that ICE has unleashed in Minnesota, and particularly in the greater Minneapolis area, is such that corporate leaders who generally have not been willing to speak, partly because some of them agree with some of the Trump administration policies, and more broadly because all of them are afraid of crossing an angry and sort of vengeful president. It's gotten to the point where they said, we have to do something, both because of what's happening and how bad it is, but also because they could start to feel that they themselves, their silence was being judged by an American public that definitely does not support this kind of activity.
Well, let's broaden the conversation here and kind of fold in another issue. We recently got floated with a headline where credit card companies would be capped at 10% annual interest. And it kind of looks like a total non-starter to people who understand the mechanics of this. It would have to pass through Congress, and it's very unlikely that it would happen. But it generated a lot of headlines, and it generated immediate backlash from the likes of Jamie Dimon and some other prominent figures who have really been vocal about this particular issue, but have also been close to the president on other issues. So how do you think that has handled, and how do you see the general playbook kind of shifting from previous administrations over the years?
So I think there are a few things that are happening. So one is the playbook with this administration has no relationship to the playbook with any previous administration, right? It just is no precedent in sort of modern American history where if you alienate the president in some way, shape, or form, he might attack you or strip you of government contracts or threaten to put you in prison, all of which he has done with, quite a few people at this point in time. So there is no way to compare this with anyone else. This is how companies react in Turkey or Russia or countries like that. No American executive has any experience with dealing with this with the President of the United States. I think you're seeing a few things that cause this kind of shift, right? The first one is the president's steadily dropping popularity ratings are making CEOs feel a little bit more free and a little bit more pressure to speak up. That's the first. The second is, as the president sort of, I think, sees those ratings and is trying to respond to them by attacking what is still the number one issue that Americans seem to be most motivated by, which is sort of rising costs. The way he's doing that is by direct interventions in the market, or at least arguing for direct interventions in the market. And CEOs hate it when the government intervenes directly in the market, particularly in ways that can limit their profits. And so naturally, they're going to push back on that. I think more broadly, like the question we're really seeing is ever since he was reelected for his second term, you've seen sort of CEOs and business leaders in general. Some of them like this stuff. Some of them are like enthusiastic, even up to and including sort of the shootings in Minnesota. You'll see people on Twitter being like, hey, I don't have a problem with it. But most of them, I think, are looking at the chaos, looking at the damage to American relations around the world, looking at the damage to the economy from policies like tariffs, and sort of saying, I can try and ride this out. But the question is, at what point the chaos is going to stop being like a cost of doing business, and when it's going to become a direct threat to the system on whose survival they depend more than anyone else. And I think in the last few weeks, with Greenland, with with what's happening in Minnesota, there have been a variety of things that are just unprecedented. A word that's massively overused right now. You're seeing CEOs start to realize that the chaos is not a cost of doing business anymore. The chaos is threatening the foundations of American peace and prosperity, and no one has benefited from that peace and prosperity more than the American corporate elite.
We have time for one more here. It's a different game for CEOs, and arguably the game was already changing because the CEO position requires a public persona in the way that, because of social media, we didn't have in previous generations and previous decades. So what can CEOs do to protect their brands and advance their agenda and also do the right thing, in quotes?
So they should first start and take Ben Franklin's advice. This is always a good idea. And as if we cannot hang, if we don't hang together, we will all hang separately, right? So any individual CEO, with a handful of exceptions of the people with such towering stature that they're basically immune from public pressure, any individual CEO who tries to confront the president of the United States is going to lose, and it won't be a close call. Those people have to band together, and they have to band together behind sort of leaders who are CEOs with more stature, sort of major figures in the financial sector or major figures in the corporate sector. We all know the names that I'm talking about. And they need to stand up and say, like, this is not supportable anymore. When peaceful protesters who are standing and exercising their constitutional right to video sort of police are shot 10 or 11 times in the back, and the government's response is to not say this is a tragedy, this is a problem, but to claim that they were domestic terrorists. That is a level of state terror that you would not see in most dictatorships, right? That is not something that you would see in like Turkey or most of the countries in the world. That is hugely out of the ordinary. It is hugely dangerous. And again, no one has benefited from the system more than the American corporate elite. It has made them the wealthiest and most powerful people in human history. If the system breaks, they will be much worse off. They have got to stand up for it now.
All right, we got to end it there, but thank you, Gautam. And coming up, we bring you some of the top trending tickers on Yahoo Finance. Do not go anywhere. Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me here for a look at USA Rare Earth, GameStop, and CoreWeave. So let's start with Rare Earth, the company announcing a letter of intent with the U.S. government for access to $1.6 billion in funding, and it does come with milestones. And this is for commercial production that would start, I believe, in late 2028. So it's a while in the future, but tell us some of the details.
Right, well, definitely the stock seeing some momentum today, up about 6% as we make our way towards the close. And what we do know is that this is going to accelerate USA Rare Earth's mining, processing, and metal making operations, particularly here in the U.S., of course. But what they're looking at is their magnet manufacturing plant in Oklahoma, as well as their Round Top deposit in West Texas. So some investment there would be flowing through as well. That's expected to begin commercial production in 2028. So as you noted, quite some time before then. But really, this comes as we heard late last year how, China makes up a majority of rare earth exports. This is part of a larger initiative by the U.S. government to really get rare earth production back here in the U.S. Of course, it's important to note here that rare earths are used heavily for defense, missiles even. And so this is integral into...
And smartphones and just about everything we use electronic-wise. So the government, just a couple more details here, getting 16.1 million shares plus 17.6 million options. And those are basically, or warrants, which are basically options. And as you said, this is part of the de-China trade because China really corners that market. All right, moving on. We got GameStop. The stock getting a boost as famed investor Michael Burry, remember him, disclosed buying shares of the company. And I should add again, because this was a 2019 story that kind of flew under my radar and erupted in 2020, late 2020, early 2021 with the retail revolution. And suddenly we knew who Roaring Kitty was and stocks were, he was testifying to Congress.
Yep.
I don't know if we're going to see a repeat, but what's happening this time?
Well, what's interesting is that over the past 5 years, this stock down more than 35%. And Michael Burry going to his new Substack letter to share the news that he's pretty much bullish on GameStop here. He said that I'm not counting on a short squeeze to realize long-term value, but I believe in Ryan Cohen, that is, the CEO of GameStop. I like the setup, the governance, the strategy as I see it. Now, I'll admit here, I'm not a subscriber to Michael Burry's Substack just yet, but I did go to Reddit to get more information on what exactly this letter did say. So what we did say here and what Michael Burry said was he pointed out the market cap. It's around $10 billion. He also said that GameStop leases all their locations. He likes their Power Up Rewards loyalty program. He also said that he really likes the collectibles business that GameStop has going on that now makes up about 30% of revenue there. And also he likes that GameStop launched Power Packs. It's a digital card trading platform. So GameStop really differentiating itself here. Michael Burry seems to like it here.
All right, we'll see if history repeats itself or simply rhymes, or doesn't do either one of those. Lastly, CoreWeave stock seeing gains after a fresh $2 billion investment from NVIDIA, and they're just adding to this. So we know that NVIDIA and CoreWeave have been tied up before. What are some of the details here?
Well, what we know today is that now this is an additional $2 billion investment in the AI cloud company, CoreWeave. We now know that this deal would help CoreWeave build more than 5 gigawatts of AI factory capacity by the year 2030, so a bit a ways away. In addition to that, they said that CoreWeave will deploy multiple generations of NVIDIA's AI systems. Now, this stock now up about 6% as we make our way towards the close, but this morning it was popping. It was up more than 10%. And so I asked Tematica Research CIO Chris Versace if now was the time to get in, and he said, maybe not. Take a listen.
I wouldn't chase CoreWeave here. I would much rather buy the companies like an NVIDIA, like a Broadcom, like a Marvell, that are kind of the arms merchants shipping chips to all of the rising capacity levels that we see out there.
And it's worth noting here that NVIDIA didn't really move too much in this announcement. It's flat today, down actually about 0.7%. Keep in mind, though, year-to-date, NVIDIA also flat.
Quick note on scale here, 5 gigawatts, and I'm saying gigawatts because that's what Doc Brown in Back to the Future pronounced it. 750,000 U.S. households can be powered by 1 gigawatt, and so 5, that's a huge amount.
Yeah.
Thank you so much for it.
Of course.
And General Motors is gearing up to report its fourth quarter results. The automaker recently warning it faces a $6 billion EV-related charge. Here with a closer look is Yahoo Finance's Praz Subramanian. Praz.
Hey, Jared, how you doing, man? So yeah, GM investors, you're looking for it to continue a strong run of quarterly performance recently with the fourth quarter results on deck for Tuesday morning. But, challenges do remain for the automaker with this tariffs and the EV business continue to be a drag on performance. So for the quarter, analysts looking for GM to post Q4 revenue of $45.4 billion, down 5% compared to a year ago, with Q4 adjusted EPS of $2.28 on adjusted EBIT of $2.77 billion. Now, GM updated its full year guidance last quarter, the main metric here being adjusted EBIT in a range of $12 to $13 billion. Now, the reason why it updated the guidance in a positive manner is because it said the tariff exposure wouldn't be as high as expected due to the MSRP offsets that the White House announced earlier in the year. Nonetheless, the tariff hit will be in the $3.5 to $4.5 billion range, so that's still not nothing there. And finally, you mentioned that EV business here, right, $6 billion. That won't affect its adjusted EBIT numbers this year, but it's both a mix of cash and non-cash impairments. Add in the $1.6 billion EV hit GM reported earlier last year, and its total loss from the EV business unit are going to be $6.6 billion, with the possibility of more to come in the future.
All right, we look forward to those earnings and your report thereon. Thank you, Praz. And as big tech earnings kick off this week, investors are once again going to be confronting the possibility of a bubble forming in the AI trade. Venture capitalist Bill Gurley sat down with Yahoo Finance executive editor Brian Sozzi for an episode of Opening Bid Unfiltered, where he pointed out that bubbles tend to follow real waves of innovation and why this could be a crucial time for venture capital.
I think that the venture capital industry lives off of these moments. You know, you have a book like The Innovator's Dilemma, where, you know, or Crossing the Chasm, like these technology waves come along and they create real opportunity for companies that, you know, just got started yesterday to take massive share from incumbents. And venture capital, without these types of disruptions, I think venture capital would be a lot harder. And so everyone gets excited. I think you've also seen in this case revenue ramp rates for some of the AI players faster than we've ever seen before in any previous wave, which is really powerful and compelling. It says that the customers are adopting the products, you know, super quickly. At this point, however, I think like running out looking for incremental investments has gotten very complicated because the venture capital community could not be more convinced that this is the biggest wave of all time. And so, you know, supply and demand start to even out. And so, you know, I heard just this week about a company that did a seed at 100 pre and is doing their A for 10 million at 300 pre. So that venture investor that's doing 10 at 300 pre is getting, you know, a tiny percent of this company relative to what people used to get. And so I just think that things have adjusted to the reality so fast that the odds of making incremental wins from here gets a lot harder.
Is that some form of indication to you that we're near some form of top for this?
You know, it's hard. You know, there are a lot of people that have talked about, is it a bubble or not? And I've started echoing this work from Corralado Perez, this academic who says, when you have big waves, it attracts speculators. So real waves always have bubbles attached to them. And she goes back, you know, 400 or 500 years. And so it's not an either or thing. It's the fact that it's real that you get speculators. And, you know, and these are opportunists that run in. And we've already seen, you know, some types of corrections. I think the Oracle, you know, boom bust thing happened very fast. You know, CoreWeave stock is way off of what it used to be. We had the Rick Perry SPAC thing, you know, data center thing that like went up and way down. So there's already been speculators that have been kind of called off a little bit. And so, you know, I do think that there will eventually be a correction. And one of the reasons that I feel strongly about that is that so many of the players, so many of the competitors, especially the deep-pocketed venture, the ones that have raised tons of venture capital, they're losing massive amounts of money, more than Uber ever lost, which was a lot.
Yes, I remember.
More than Amazon ever lost. And so the burn rates are bigger than they've ever been in the history of venture capital. And eventually they're going to want to bring those in. And when they do, like when people right now in almost every one of these categories, the leading players not pricing the cost, they're pricing to take share. And so at some point, like, and I don't know what causes that. It's just some type of exhaustion from the capital markets. These companies then have to do what Uber did, which is transition from losing money to being cash flow positive. And as they do that, the pricing for these products is going to shift. And you know, I just feel like that's going to be a moment of a correction. There's another thing, which is if you go back to the .com period, you know, when all these companies first started, they were all on Oracle and they were all on Sun. And they were spending, you know, a third of the venture capital they raised on these servers that they were propping up. 5 years later, they shifted all to Linux and MySQL and open source. So you went from a period of innovation to a period of optimization where people are much more worried about cost. And I think that could happen here. I mean, I think there's some really interesting questions about the open source models versus the proprietary models, the alternative inference, you know, architectures, like Grok, which NVIDIA just bought, but also Cerebras and some of those others. So there's those two things. I think when the startups finally have to prove unit economics, and as we and simultaneously we start looking for optimization, you could see some things move around.
Then are you concerned?
The Google TPU architecture as well is a competitive alternative.
Are you concerned that, I guess, OpenAI is some form of this generation's Sun Microsystems, where maybe it's not a direct comparison, but OpenAI is at the center of so many of these deals. And for them to make these deals work, they have to hit profitability at some point over the next 10 years.
Yeah, I think it's created risk for everybody that they have they've committed to so many deals in so many different places. It's almost like everyone's dependent on them surviving. And that is another thing that could lead to a correction if they ever have to start defaulting on some of those commitments. And so, we'll see. The other thing that's I think part of the reason why you've had the CoreWeave type correction, the Oracle correction, and the Rick, I don't know, I should know the name of the Rick Perry SPAC, but I don't, is...
Well, Rick Perry SPAC, it's fine. It works.
Data centers are really hard to build. And we already know that there's shortages of energy. Everyone's talked about it. So just the pure mental exercise of assuming that they would make it on budget, on time, is probably incorrect, right? I think almost specifically going to be incorrect.
Bill, is there, you get to see so many companies early in their lifespan. Is there another Mag 7 waiting in the wings? Will there ever be another Microsoft, a Google? Are any companies catching your attention?
Well, look, I mean, I think that you have to look at what the capital markets have done. And, players like Thrive and Altimeter Co. 2 and SoftBank committing to OpenAI, they clearly, you're not funding something at 300 billion pre, 400, 500 billion pre, if you don't already believe that. So there are a lot of very proven investors who have made big bets, across multiple decades, that have already decided what you said is true about OpenAI.
How do you go about learning from greatness? That was another key topic in this. I think greatness, I'm sure a lot of people think, just staying in tech, NVIDIA CEO Jensen Huang has just created this amazing companies at the center of the AI revolution. But how do you go about studying a Jensen Huang and trying to repeat some form of success that he has had?
I think the first thing I would say is, and I think this is also a great test for whether you're truly passionate about a particular job or category, is to go study the history of it and to know it all. There's a scene in the book where we uncovered there was a chess tournament where they took a break and did a trivia contest, and Magnus Carlsen won the trivia contest. So he knew more about the history of chess. If you go to the Picasso Museum in Barcelona, it's arranged chronologically, and he was a expert kind of realist at 14, which most people don't know. And I think there's an element of, and Danny did this too, I think there's just an element of knowing the history and having that as bedrock as you start to build upon what you're going to do. You're going to innovate away from that. You're not just going to mimic them. But I think that's super important. And I would also say it's highly, highly differentiating when you try and meet mentors, when you interview for jobs. Pick any job you might interview for. And let's say you're a candidate that knows more about the history of that area, and you are able to convey that in the meeting. Think how differentiating that's going to be. You signal to people that you really care and that you want to understand and that it matters to you, and that's powerful. It's super powerful. So I think once you get that as a bedrock, then you go on the continuous learning journey and you build on top of that. But I think it's essential, and once again, it's near free. And here's the other thing: if you go to start doing that and it's boring to you, switch fields. Like, go do something else. You know, if that's just not interesting to you. I haven't met a great investor who hasn't studied Warren Buffett.
Coming up, we take a look at the Fed's next Fed decision out next Wednesday at 2 p.m. That's up next on Market Domination. The Fed's policy meeting this week is in focus for investors. The central bank is expected to hold interest rates steady. Now, this meeting comes as legal tensions hang overhead for the Fed. And here to discuss is Dennis Lockhart. He is a former president of the Federal Reserve Bank of Atlanta. Dennis, it's great to see you here. So I was just checking what the bond market is predicting and not expecting a rate cut until the very end of July. That's a while out. But what's going to be in focus this meeting?
You know, with all the excitement around the Fed in the last couple of weeks, the Lisa Cook hearing and the Powell investigation,
yes,
and the speculation about the next chair, this could be a boring meeting. You know, I don't think the committee certainly is not going to make any decisions about lowering rates, and I suspect they will simply talk about what they're picking up on the economy and leave it at that. So some of the communication, including the press conference, could really be minimal.
Well, let's talk about the odds of who's going to lead the Fed next. And also, will Jerome Powell possibly stay on at the Fed to kind of maintain a little bit of consistency, at least one more vote? How do you see this whole thing playing out? Is it one of the Kevins in the end? Is it who?
Well, apparently we're going to hear the nominees pretty shortly. At least that's a speculation that could come as soon as this week. And, you know, I don't know how to read the thinking of the president on this. You know, given his agenda for much lower rates, I tend to believe that he will ultimately opt for someone he thinks is loyal and who will push his agenda in the committee. And I still believe Hassett is probably the most likely one to meet that criterion. But who knows? You know, it could be last impressions, as has happened before.
Does Rick Rieder, who is now the front runner, at least in terms of betting market odds, and you know there's not a huge depth of liquidity in those markets anyway, but does he have a shot at this? Does he pass Senate confirmation? Doesn't have a whole lot of history with the Federal Reserve.
I think he has a shot at it because he's an expert on fixed income and the bond markets, and in some respects, because he's not an insider, may have some advantage. But at the end of the day, I think the president more likely is going to go with someone that he has had enough contact with to develop some trust that this person will be his emissary to the Fed. And I'm not sure Rick Rieder qualifies in that respect. They're all qualified candidates. So, you know, could be Rieder, but could very well be any of the other three.
Well, let's talk about the balance of risks here and the Fed's dual mandate, maximum employment, stable prices, meaning inflation, holding steady here. What do you see the risks in the market? Does the Fed have ammunition to potentially lower rates, you know, even in July or later in the year? Or do you just think it's kind of done now?
Well, I don't think you can count on anything because the circumstances can change dramatically. But given the momentum of the economy coming into this year and the relative stability of the employment markets, the stickiness of inflation of around 2.7%, depending on how you measure it, in my opinion, it's a perfect time to just wait a few meetings and see how things develop. And I'd add to that historically the first quarter is often thrown a curveball. Even last year, 2025, the first quarter was different than the other 3 quarters of the year, much weaker. So that suggests that you should be patient into the spring and even into the summer before you have a clear picture of how things are trending.
We got under a minute here, but we got time for one more. Anything we didn't cover? What's on your mind here that you'd like to tell the viewers?
Well, what was on my mind a week or so ago would have been Fed independence and all the risk associated with that. The winds have blown favorably in terms of Fed independence, at least in some respects. The Supreme Court hearings seem to suggest support for Lisa Cook staying in the job and some different treatment of the Fed. So I'm a little bit less concerned about that. The thing that would be on my mind is who's going to succeed Jay Powell, because I think that leadership is important to the whole world, not to say the United States. And we really want to have someone who will lead the committee with adequate independence.
I'm with you there. Thank you so much for your time here, Dennis.
Thank you so much, Jared.
And we are wrapping up today's Market Domination. Do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.